This is John Prasinos, Editorial Director of Investing Daily. To view our full range of publications, visit our website at www.investingdaily.com. You know, I find it valuable to occasionally step back from the market's daily noise and gyrations and reflect on the long view. The questions and comments that I receive via email help me in this regard. Letters to the editor play a dual role in publishing. They help share knowledge and they serve a corrective function. Let's dive into my inbox and see what readers are asking. The failures in March of Silicon Valley Bank, Silvergate Capital, and Signature Bank, as well as the cryptocurrency crash, they've all raised concerns about speculative excesses in financial markets. Which brings me to this email from a reader. What can the crash of 1929 teach us today? Tom K. For perspective, let's take a quick look at the fateful year of 1929, its consequences, and a few of its lessons. The Great Depression began in 1929 when, in a period of 10 weeks, stocks in the New York Stock Exchange lost 50% of their value. As stocks continued to fall during the early 1930s, businesses went bankrupt, people lost their jobs and homes, and unemployment rose to nearly 25%. The first day of the prolonged stock market crash was October 24, 1929, aka Black Thursday. 5 days later, on October 29, another crash occurred known as Black Tuesday. Leading up to Black Thursday was unbridled investor euphoria. Bernard Baruch, financial advisor to President Franklin Roosevelt, described the atmosphere immediately before the crash of 1929. He said, "Taxi drivers told you what to buy. The shoeshine boy could give you a summary of the day's financial news as he worked with rag and polish. An old beggar, who regularly patrolled the street in front of my office, now gave me tips and, I suppose, spent the money I and others gave him in the market. My cook had a brokerage account and followed the ticker closely. Her paper profits were quickly blown away in the gale of 1929. Baruch was the investment guru of his day. He sold his stocks just before Black Thursday. He made a fortune. He once said, "I made my money by selling too soon." There's panic buying when a market is soaring, i.e. fear of missing out, and there's panic selling when a market crashes. Bernard Baruch knew this and acted accordingly. He died a wealthy man. Here's the next reader email. You state that you're bullish over the long term, but you also expect volatility and perhaps a sell-off over the near term. How can I protect my portfolio? Bill H. Under current market conditions, at least 15% of your portfolio should be devoted to hedges. As part of your hedges sleeve, between 5 and 10% should be in precious metals, such as gold. I prefer gold mining stocks to physical bullion or funds. Gold has been on a tear this year, and it probably has further to run. If you own gold mining stocks and the price of gold goes up, the notion of operating leverage comes into effect. A bump in gold prices will likely exert an exponentially huge boost on a gold producer's top-line revenue. And because the producer doesn't have to put a whole lot of additional labor or capital into digging out increasingly valuable gold, its earnings per share should go up and take the stock's price with it. Another reader asks, I've often heard of an options trading strategy known as covered calls. How do they work, and are they suitable for conservative investors? James M. A covered call refers to a trade in which the investor selling call options owns an equivalent amount of the underlying security. To execute a covered call, an investor holding a long position in an asset then writes, i.e. sells, call options on that same asset to generate an income stream. The investor's long position in the asset is the, quote, cover, because it means the seller can pony up the shares if the buyer of the call option chooses to exercise. That makes covered calls suitable for conservative investors. Let's turn to my colleague Robert Rapier, Chief Investment Strategist of Utility Forecaster, who regularly deploys the covered call strategy. Robert Rapier explains, selling covered calls offers us a lucrative additional source of income to supplement quarterly dividends. I don't consider this to be trading options. When I sell these calls, I generally don't intend to ever buy them back. I collect the premium to supplement the dividend, and then hope that the stock is not called away. If it is, I am consoled by the fact that I will typically get a more than 15% premium in the share price for a call that expires in 6 months. To learn more about Robert Rapier's money-making methods, consult the article that accompanies this video on the Investing Daily website. In the meantime, if you have any questions or comments, Please don't hesitate to send an email to mailbag@investingdaily.com. Bye for now.